ASML is one of the best semiconductor companies to hold in your portfolio. We'll explain why in today's episode. We're also going to take a look, is it an undervalued strong buy now? They have reported their earnings. As always, we'll look at their historical performance. We'll look at their top line revenues to see how they've progressed over the last 5 years, as well as their bottom line net income after reporting. We'll also look at the balance sheet, their total cash versus their total debt to get a gauge of the health of their company. And as always, we'll look to see how they've performed over the last 5 years versus some of their well-known competitors. We'll look at that dividend safety, dividend yield theory, as well as their financial metrics. We'll touch upon insider trading, insider buys, insider sells. We'll also see what the institutions have been doing over the more recent quarters. And as we mentioned, we will touch upon their earnings, how their full year 2023 report went, as well as a few things to point out from the CEO's statement on these results. And don't forget, we will run them through the valuation model, getting to the intrinsic value, getting to our acceptable buy price with our margin of safety, and seeing what Wall Street are forecasting for this company over the next 12 months. So let's jump into their historical performance. Now we can see this has been up 33.5% over the last year. It is trading now towards the 52-week low. Do bear in mind, just because a company is at a 52-week low, it is never an overvaluation signal. Their trailing 12-month yield is under 1% and their forward P at 43. Now, if you've been holding this company over the last 10 years, you would be up a phenomenal 892%. Do bear in mind that doesn't include those dividends reinvested. Now, before we look into the income statement, let's very quickly touch upon their full year results. Now, their revenue, as we can see, up 30% from the previous year. Their bottom line up 39% from FY22. And it's also nice to see their profit margin 28%, up 1 percentage point from the previous year. And earnings per share as well, 19.91 versus 14.14 from FY22. So very, very strong results. It's kind of what you expect with this very high quality company. Just a few things to point out here then. In terms of versus analyst estimates, well, revenue exceeded that by 1.3% and earnings per share beat by 2.4%. So it was a double beat, both on the revenue and the earnings per share. But just something to point out in terms of the driver behind the last 12 months, this was essentially that Taiwan segment, which comes to around 24% of their total revenue. And one thing to know for those that are new to this company, they do spend a lot on R&D. As we can see here, it did amount to 63% of their total expenses. Now, looking forwards, their revenue is forecasted to grow 11% year on year on average over the next 10 years. Which, as we can see, when you compare that to a 10% growth forecast for the industry in Europe, that is looking very strong. Now, one thing that I did want to bring out from the CEO's statement, for those that don't know, they have a huge backlog, as we can see here, 39 billion euros worth. So this is a phenomenal company, a very high quality one. And now let's get into the numbers. Now, top line revenue, as always, 3 to 7% at the minimum, but it wouldn't be surprising to expect more from this company. 13.3 billion reported in 2019 on the top line, 30.4 in December 23 from that latest annual report. Absolutely phenomenal, more than doubled their top line over the last 5 years. And if we want to get into the granularity of the top line, we see increases every single year. So very, very strong for ASML. Now let's take a look at that bottom line. Can we see any similarities? Well, 3 billion or just under reported in net income in 2019. 8.7 billion in 2023, more than doubled their bottom line as well, which is absolutely phenomenal. We do see some inconsistencies. Their bottom line did increase to 2021 before around a 10% drop, but we see it did pick up very strongly. So yes, a small inconsistency in the net income, but nonetheless, their top line and bottom line absolutely phenomenal with those increases. Now, a quick health check, total cash versus total debt, 5.3 billion in 2019, 7.7 billion in their latest report. So they are holding nearly 50% more cash than they did 5 years ago. When we check in on that total debt figure, what we can see is that their total debt comes at 3.7 billion in 2019, 5.5 billion in their latest report. So very, very strong to see. They don't have a very large debt balance as well. So far there are a lot of positives that you should be noting from this company. Now, when we do look at this industry, the semiconductor, we have Applied Materials, Lam Research, as well as a few well-known others. Over the last year, what we see, ASML, now this includes those dividends reinvested, are up 35%. But interestingly enough, as we can see, the industry as a whole has performed very well. We have some names here up 78%, KLAC up 56%, ENTG up 58%. So we can see some trends when looking at this data. Now, when we extend it to the last 5 years, absolutely phenomenal again for this industry. ASML up 416%, AMAT up 363%. We can just see lots of names, and even the worst performing up 193%. Now, yes, just because ASML have performed very strongly over the last 10 years, or 5 years in fact, it doesn't necessarily mean it indicates future performance, but always good to see. Very briefly, as always, we have a look to see any insider buys or sells, but over the last 3 months, in fact, when we extend it to the last year, there isn't anything to talk about here, but we did take a look just in case you were interested to know. Institutional ownership, 19%, $5.5 billion worth of sales by these institutions over the last 12 months. A little bit more buying than selling, as we can see over the same period. Now, specific to 2023, Q1, we see more buying by the institutions. Q2, we see the opposite, with Q3 and the latest Q4 quarter, institutions buying shares of ASML. Remember, especially for new viewers, always do your own due diligence and don't copy what the institutions are doing. Now, in terms of the dividend safety score, 82, it is very safe. Market cap, $341 billion. It is a mega cap company. Now let's take a look at those key recessionary metrics. Well, last recession, in fact, they cut the dividend. They had below average growth, negative 56% versus the S&P's negative 12%, and they pretty much got the same return, negative 55%, as the S&P's. Dividend growth, well, there is a lot to love. Unfortunately, in July last year, they did give a 5.8 increase. Now, typically you might say it is above inflation at 4%, but with ASML, we are used to these very high double-digit dividend increases every single year. So it was a bit disappointing. I do hope this summer we do see a double-digit increase given how strongly they've performed. And just to note, they have been increasing those dividends for the last 14 years. In terms of dividend yield theory, well, as always, it states a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation, 0.73 versus 0.47. And just to note, however, with the forward PE, it is significantly higher, 43 versus that 5-year average of 33. PE comparison, well, ASML is very high. The information technology at 24.8 is significantly lower. Free cash flow, remember, always focus on free cash flow. Earnings is susceptible to manipulation by management through accounting, and we have discussed many examples on the channel. Personally, below 60% is what I like to see. Semiconductors, you can bring it down to 50%, but around that 50 to 60%, in my opinion, shows that management have that ability to offer those double-digit dividend increases. 2023 at 74%. Now, this is why it's good to see, because you could have anticipated that single-digit dividend increase, whereas when you looked at the earnings at 31%, you may have been very surprised. In better news, 2024 it is expected to be 20%, so this summer I am expecting a nice, juicy double-digit dividend increase. In terms of the free cash flow per share, well, 153 in 2014, 825 in 2023. Now, yes, it has grown, but we did see some very strong years in 21 and 22. Better news, 2024 is expected to go even higher at 1730. Sales growth, what we love to see, and bear in mind, as we saw the CEO, they have a humongous backlog order, which they have had for many years. So this is a very strong company when looking at that part of the business. Double-digit growth nearly every single year. 2023 alone, 30% increase to the top line. Absolutely phenomenal. And we can see here, 5.9 billion of sales in 2014, 28 in 2023. On top of all of this good metrics, they also do share buybacks, returning excess cash to investor pockets. 440 million shares outstanding in 2014. They have essentially bought back 10% of those shares outstanding. 2023 at 394. ROIC, now remember, for those that are new, personally I don't invest in companies that don't have at least a minimum 10% on this metric, as it does show us that management are able to effectively allocate their capital if they do. The last 3 years in the high 40s, absolutely incredible. This is a very strong company. Even before then, they still had a very high ROIC metric. Both operating margin and free cash flow margin above the minimums For the semiconductor at 16%, the operating is not only very strong, very above that 16% level, but it is also increasing. They are becoming more efficient. Free cash flow margin a bit more inconsistent, but positive to note, it is above that minimum 5% level we look for. Now, this is one of the most important metrics for me when I look alongside the ROIC, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. It shows us the dividend safety as well as the strength of the balance sheet. Now, these show us the number of years it would take the company to pay off all of their debt net of cash on hand. So what this means, they have a very strong balance sheet. It wouldn't even take ASML one day to pay off all of their debt. Absolutely phenomenal. Now, yes, this is a very strong company, but let's look at the valuation. Is this one that is undervalued, and at what price should we be looking to buy? So, as always, if you do enjoy the content values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, what we can see with Graham's valuation, you should now know that this isn't applicable due to the fact that they have very, very strong revenue growth, double digit nearly every single year. And with the multiple valuation, while we do have some companies that are in a similar sector and size, due to the fact that this company is very strong, they do have a very high forward PE. I do believe that a lot of that is justified, their backlog, their very strong revenue growth and their metrics. So I don't believe this will be applicable for today's episode. So the first model we're starting off with is the dividend discount model with that dividend year on year, as we can see here. Average growth at 28%, absolutely phenomenal. Forward looking, I've gone 7.25%. Now this comes to an intrinsic value of $878. So we have an undervaluation signal here. Bear in mind though, it isn't that much more than the current market value. We then move on to the DCF model, my favorite model with the free cash flows year on year. Average growth rate, very high, 38.5%. Forward looking, gone slightly lower than analyst estimates. And in conjunction with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. We have an intrinsic value of $957, another sign of undervaluation. As always, the intrinsic value is the average of the models, and in today's episode, it's the average of these two coming to $917. Don't forget, you can grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list by clicking on that pinned comment below. So we'll start off with a margin of safety of 10%, which we'll use, and we use that personally if it meets three criteria: wide moat, strong financial metrics, good forward-looking data. Now you can see for ASML, it doesn't warrant a 10% margin of safety, but it does warrant a 5% up to $872. Now, different investors will have different investment theses and their level of risk, but this is a very high quality company in my opinion. Now, whilst I wouldn't be buying at a 5% margin of safety, I would like at least a 15% at a bare minimum, ideally 20%. So anywhere in the low 700s is where it is on my watch list, and I will add shares of this as I do believe it is a phenomenal company. It has a huge backlog. The increases to their top line year on year is sustainable, and we can see on top of that it is very consistent. In terms of Wall Street and what they forecast, well, we can see $913 with upside of 5%. So they have a price target, as we can see, not that far off the current trading price, not far off our intrinsic value either. Now, personally, as we did see over the last 5 years, the semiconductor industry has been booming, and it looks like this could be one that you should consider to add to your portfolio or on your watch list and wait for the right price. We will take a look at other semiconductors, so do let us know in the comments below if there are any in particular that you like, or if you do believe there are some that are undervalued. As always, if you enjoyed today's episode, smash that like button, hit the subscribe and bell button, and we'll see you all on the next one. Take care for now.